So the first thing we do when we encounter any data, and if we wanted to sort of look at the features within the data, right? You would want to sort of plot some of these things, right? And we are doing just that. So the first thing we are going to do is do this box and whiskers plot, okay? And you're going to come across this thing whenever you're looking at distribution or the spread, right? And this box and whisker plot, what it does is it basically takes each column in that data set we were looking at, and it arranges it in ascending order, for example, right? And it plots the spread of that data, right? So that black line you see in the center of this plot, okay? So you're basically stacking all these different asset classes, and you're trying to sort of understand. So this is you're plotting all these asset classes against returns, right? As to what the different returns numbers are for these different types of investments, right? And you see the center line is basically the median, okay? This is the 25th percentile. That means so there are four segments, right? There is this long I guess whiskers on this side and that side, so that's a whisker. And then you have a box, okay? So that's why it's called box and whisker, right? Center line is the median. This is the first 25% of the data. This is the next 25%. This is the next 25% after the median, and this is the last 25%, okay? That means if you had 10 data points, right? Let's take 12, okay? 3 are here in ascending order, okay? So if you had a column with say 12 data entries, okay, 3 would be here, 3 would be here, and of course there is a center point between those middle part, okay, of that ascending order of the data. Then 3 would be here and 3 would be here, right? So and I think I write about this here. For example, say you have a data series with 5 data points, 3, 2, 5, 9, 7. The sorted series then is 2, 3, 5, 7, 9. The median hence is 5, okay, because that's the middle point, right? And 25th, 75th percentile, and so on, so right. So let's see what we can see in this data, right? What we can see is if you were to compare different returns, because these are annualized returns, right? So we were looking at it returns by every year, right? You see that the small company stocks, okay, the small cap stocks have if you look at the median as a center point, you can sort of say, look at this plot as, it looks like that the small company stocks are the ones which are doing the best, followed I think by this real estate kind of sector investment, right? And then probably large company, and then probably commodities and international and so on, so right. So you would expect, right? You would expect that if you were to put in money into this category of investment, okay, in this category of investments, say in 1970, let's say you put in $1,000, right, and you just let it sit for 48 years or 49 years of time until 2018, you would expect to have a lot more money in this, because every year it is technically doing whatever that 10, maybe 16%, okay, as a median, right? And we'll see why that is not a good way to look at it, right? And why that is not the right information we need, okay? But you would expect this to make the most money, followed by this, followed probably by this, this, and this, right? So let's keep track of that, okay? And you can also see that some have even bigger spread, okay? Like commodities have basically pretty wild swings, right? That means in some years it has gone down a lot, in some years it has gone up a lot, right? Cash is basically short-term investments, right, where you actually open a money market account. So we don't want to get into as to what the logic behind why cash should vary as much, but you can see that it has pretty low volatility. Okay, uh, and we're going to get into as to how do we define volatility in terms of statistical terms, right? Uh, but cash is pretty less volatile, and so and so, right? So you would expect that, okay. But what made the most amount of money? Okay, so let's see. Don't worry about this code. Okay, we are going to go through knowing how to do it, right? But look at this thing, right? So if you put in $1,000 in 1970 and you left it there in different types of investments, which is large U.S. equity and all, right? Each $1,000 in REIT, okay, REIT, which is the real estate sector, is around 250K, right? $250,000, right? So if you had $1,000 back in 1970 or the start of 1970, which if you put it in and looked at it in 2018, it's a lot of time, of course, right? But that's the nature of the market, right? That's what you. I'm not saying that you should expect this every 49, 50 years, but you need to give it time for that compounding, that effect of compounding to work, right? But you see that the REITs have actually made the most amount of money, followed by, I think, the small and large cap. Okay, you see this? So small cap is green, large cap is sort of pink. Okay, and then is non-US equity, right? So non-US equity, which is international companies, have not done as well, right? Actually, they have done pretty terrible, right? And if you look at the cash, you see between real estate and small company stock and large company US stocks, you see a lot of up and down. Look at this, okay? And I'm not sure how many of you were paying attention. This time period was basically the 2007, 8, 9 financial crisis, which was technically led by real estate type of investments, right? So you see there is a pretty big steep drop, and then there is a spike up, right? Which was basically the recovery after that crash, right? But the cash is pretty flat, right? It's not as volatile. So are bonds not as volatile, right? Which is expected, because when you are a bondholder, that is when you lend money to companies and governments and all those things, you are first in line. You get your interest payment regardless of what happens to that company and how they do it, unless it goes bankrupt, right? You pretty much get your money back. So when I say bonds, you just don't own one bond. You probably own thousands of bonds. So everything going bankrupt is not going to be possible, right? Because then we will have bigger things to worry about, right? Same thing, in each of this category you have multiple different investments, so the category by itself doesn't go away, okay? Hopefully not, right? Because if it does go away, then none of this will matter, right? Because we will have bigger things to worry about, right? So if you look at this thing, so why is small company stock doing like not as much as real estate, right? It's like less than half of what you would expect, because what you would expect here is that the small company stocks should technically do better than real estate, right? Okay. So what that tells you is that maybe this is not the right way to look at the data. Okay, this is good information, right? So you always want to sort of have this information in your back pocket, as well as say look at the distribution, right? So box and whisker is convenient for comparing summary statistics. So I have some data on that. Some write up on that. But a better way to look at it is like look at the distribution, right? And that's and we are going to talk about that as to what a distribution is and all those things, right? But this is basically giving you a flavor of how the data is spread out, right? And you see there are in commodities. See, commodities sucked. Okay, so commodities basically did pretty terrible, right? If you look at $1,000 in commodities in 1970 is around say $10,000 or maybe $20,000, which is not a lot of growth, right? You were actually better off investing in bonds, which are technically safe. They don't go up and down as much, right? So you did better by buying bonds than buying commodities, technically, right? But this gap is pretty surprising, right? So REITs versus small and large company stocks, because we were expecting small company stocks to do better than REITs because of what the box and whisker plot shows, right? And this is where you can sort of make sense of why that is the case, right? So if you look at the zero line, which is, we are looking at the same kind of a stack plot, right? So this is a neat way to sort of arrange your data in a way which you can look at information on the same scale, right? So you always think about you always want to think about when you're showcasing data, when you're visualizing data, whether you have the right set of information to sort of explore and make comparisons with, right? So here, if you look at this, right, the small company stocks have a lot more area under the curve to the left of zero line as opposed to the right, as compared to the REIT, right? See, so if you have a bigger chunk here than REIT, and that probably explains a little bit of the difference, and that's a huge difference, right? So what that tells you is that the volatility, okay, which in statistical term we're going to call it standard deviation, which we're going to cover later, has a huge influence on the amount of money you end up with, right? So that's where this mean variance is basically standard deviation, okay? That is where mean variance optimization comes in, okay? And that's the whole logic whole logic behind what Harry Markowitz was trying to explain, right? And look at commodities. Commodities is basically just flat, right? It has a lot more years which it was down, and a lot more years it was up, right? But you want to minimize the amount of down, right? You see, look at commodities. We would have made more money being invested in supposedly safe bonds than in commodities. So even then, there were more years with higher returns in commodities than they were in bonds, right? So if you were to look at, if you were to sort of get this data and say, hey, would you want to invest in commodities or would you want to invest in bonds? You say, you know what, of course I'm going to pick commodities, but because look at the amount of returns you have, which is right of the zero line, is pretty high, right, as compared to the bonds. The centrality tells you that this is not going to yield as much, but in fact this yields more because it doesn't have a lot of volatility, okay? And that's where you want to keep in mind that you just don't want to look for high returns. You also want to look for high returns with as little volatility as possible. Volatility is a very important component of that, right? Because when you lose when $100 becomes $50, for that $50 to become $100, you need 100% gain, okay, not a 50% gain, right? So you want to sort of minimize that volatility as much as possible, okay? So let's look at what else. So if you look at bonds, so we're just going to compare three different asset classes, right? Bonds, large US equity and REITs, right? So you see some pretty steep drops, right? So you have to endure through all these things in order to sort of get on the other side to make the kind of money this asset classes did, right? And these are the drawdowns. So this is basically showing as to how long does it take for the portfolio to drop, being invested in that company and then recover. Okay, so I don't want to drag on too much on this. There is a lot of reading you can do on your own terms, but I'm always available to sort of talk about and clarify any doubts you might have. Okay.